How's it going, investors? I'm Ari, and welcome to the channel where I'm talking both value and dividend investing for you all. Now, if you are brand new here, I started YouTubing my financial journey back in 2019 to simply show you all through how simple investing really is, as long as you have a process and stick to that process through the ups and the downs of the market swings. Now, very recently, I smashed my own personal goal of hitting $100,000 for my brokerage account. Given all this recent volatility, we're actually down 10 to 12%, where my account is now sitting at $95,780.70. However, this is now the opportune time for investors like you and I, if you're a long-term value investor, to actually jump into the market, double down on positions. So that's exactly what we're going to get into today. 7 high-quality stocks that are trading at or below fair value. So just before we dive in, make sure you tap on that thumbs up button. It certainly helps me out in growing this channel. And if you haven't already subscribed, I'd absolutely love to have you on this journey with me. So go ahead, tap on that subscribe button as well. Now, YouTube, let's dive right in. Now, before I get to actually breaking down these 7 stocks that I have for you today, I quickly just want to mention that we may be pretty far from a market bottom, and for that matter, an actual bull market. We have economic reports that are still showing strength in the labor market, which ultimately just pushes the Federal Reserve to continue at their current game of bringing down inflation no matter the cost. And come October 13th, another CPI release date, which will be important for investors to digest. Now, regardless of that inflationary figure, I'm safely assuming that the Federal Reserve is going to continue on with their mission, and don't be fooled by any emotional investors out there who are going to spark a mini rally. It will, after all, just be a mini rally. Now, with that said, I want to get to breaking down our first stock of the day, which is Amcor, ticker symbol AMCR, which is a global packaging company that manufactures flexible packaging as well as rigid containers servicing food, beverage, pharmaceutical, medical device, and home or personal care companies. And while it may not be the most exciting investment, we're not really here for the dopamine rush, but rather cash flow and reliability, which Amcor has just been delivering through on just that since its founding in 1860. With all of this growth over the years, Amcor has been able to amass a market capitalization of over $16.5 billion. However, with clients of Amcor's taking a massive hit from all these economic conditions, mainly a reduction in consumer spending, Amcor certainly feels that pinch by default, which we see in turn in their stock share price sliding nominally by 3.82% over the course of the year, trading now for $11.09 per share, with a current P/E ratio sitting just above 20. Yet with an economic turnaround, or even before a complete recovery, a play like Amcor may be well worth the investment, especially for its reliability. Now, analysts certainly believe so as well, with a target share price coming in at $12.88 per share. That's roughly 16% worth of upside, and with the ability to collect on Amcor's reliable dividend that they have been shelling out for the past 39 years and currently coming in at 4.25%, it's one heck of a steal. Next up, I want to talk about the largest manufacturer of construction engines, Caterpillar, ticker symbol CAT, which I'm sure you're all very familiar with, as it's a global industry leader with their engines on just about every single continent. Now, with rising recessionary fears, Caterpillar has certainly taken a direct hit, with their share price falling to $178 per share, getting nearly a 13% change. And with a P/E ratio at 14.4, this is quite an opportunity for us value investors. Now, even if we are to experience a deeper than anticipated recession, I welcome this recession, given the opportunity that we can only then buy Caterpillar on even a steeper discount. And not only is this a construction industry leader that's not going to be going anywhere anytime soon with its $94.17 billion market capitalization, but when it comes to economic conditions returning to a more of a norm, construction projects will certainly be roaring back, and then therefore Caterpillar's stock share price will be taking off. Looking into the future, analysts are aligned with such optimism on Caterpillar, with a target share price coming up to $219.17 per share, which is over 22% worth of upside. And more interestingly to note here is taking a look at what smart money has been doing. And of course, they have been investing millions of dollars into Caterpillar, starting with More Capital Management here, investing over $15 million, to Fisher Asset Management's $1.3 billion investment, and then another $1.3 billion here from Bill Gates's fund, we await for such a recovery, shareholders are going to be able to enjoy Caterpillar's dividend that they've been shelling out for 29 consecutive years with a current dividend yield at 2.65%. As for the third stock that I want to go ahead and break down, it's actually ideal for both the near and the long term and whichever market conditions present themselves. We have Procter & Gamble, ticker symbol PG, which is just a powerhouse of a consumer goods company that was founded in 1837 and has since taken over multiple consumer verticals with their baby products like diapers to their detergents and personal care products like deodorants and toothpaste, shampoos and medicines. You name it, Procter & Gamble is probably making it, which makes Procter & Gamble an ideal investment to have within your portfolio regardless of the state of the market, especially with over $308 billion worth of a market capitalization, meaning you just need the right buy-in price when it comes to Procter & Gamble, which may be a challenge given its premium that it's typically actually trading for, and that's due to the safety that it allows you to have as an investor. Their current P/E ratio is hovering around 22.4, and it is down on the year by 20%, trading for only $129.20 per share. And despite that premium that's paid, hedge funds have certainly not stopped buying into the position, which only builds confidence for me as a smaller scale investor. It also provides a positive sign that analysts are also showing 20% worth of upside, with a target share price coming up to $154 per share. And with some patience until Procter & Gamble actually rebounds, there is a 2.77% dividend yield for shareholders. All right, now with Amcor, Caterpillar, and Procter & Gamble all out of the way, I'm going to pre-warn you about these next four stocks that are the four of today's bunch that have just been absolutely pummeled by market conditions as high inflation and general recessionary fears have altered consumer habits and impacted all four of these companies. Yet with time and an eventual market recovery, these are the four investments that I really do believe are worth the wait and why I invest with a personal slogan that it pays to be patient. So with all of that being said, we have the 7th largest retailer in the United States, Target, ticker symbol TGT, which has been severely hit as inflation rose and consumer fears are heightened, thus altering spending habits. Target ultimately was forced to mark down a lot of expensive items and is still struggling with inventories, all of which is reflecting in their massive sell-off in the share price, coming down to $156 per share, where it was once at $246 per share. Overall, that's about a 31% change on the year, with a P/E ratio coming in far below its competition at 17.8. Now it gets even more interesting because while many are backing away from such an investment, we have hedge fund after hedge fund that has simply been pouring millions of dollars into Target. Of course, there is plenty of upside predicted with a stock that has been battered like Target, and we're taking a look at a Target share price coming in at $194.86 from top analysts. That's almost 25% worth of upside. Now, could Target certainly experience more trouble in the future? Of course it could. However, in the longer term, it is expected, of course, to rebound. So I am definitely interested in taking a look into Target, especially as I wait here. I can collect on a dividend coming in at 2.49%. Moving to even more of a volatile stock that has been knocked for quite some time now with tremendous upside potential for the long-term value investor, we have T. Rowe Price, ticker symbol TROW, which is a global investment management firm offering funds, account management, and retirement planning for both individuals as well as institutions. Now, it has been in business since 1937 and has just been a prominent name within the industry, growing their market capitalization to $25.35 billion as of now. However, over the last 2 to 3 years, T. Rowe Price has been trading for some pretty scary valuations, currently at $111 per share, down 40% from the beginning of the year, where it was once trading for around $189 per share. Now, when it comes to T. Rowe Price, it's important to just keep in mind that the vast majority of their assets are invested into the NASDAQ. So just take a moment to think about that one, as the NASDAQ has been pummeled over the last 2 to 3 years. But we must look ahead at where the future is heading, and of course smart money has been doing just that, so it's no surprise here that hedge fund after hedge fund has been buying into T. Rowe Price more recently, along with analysts foreseeing a great comeback coming T. Rowe Price's way, as it's the industry kingpin with a target share price coming up to $138 per share on the high end. And because I believe we have some time until a full economic recovery, shareholders will certainly be able to take advantage of a 4.3% dividend yield. Now, if your gut didn't drop with an investment like T. Rowe Price, I'm sure it will with these next two stocks, both of which are down on the year by over 50% worth of declines. and they're screaming opportunity to an investor like myself. Let's go ahead and talk about Stanley Black & Decker, ticker symbol SWK. This one I spoke about now in a couple different videos, and I personally actually just invested thousands of dollars into the company, building up my position for the long term. But I'm in full belief that an investment in Stanley Black will be back. We, after all, are talking about the largest tool manufacturer in the entire world, talking about 50 manufacturing facilities just within the United States and over 100 more on a global scale. Now, since their founding in 1843, Stanley Black & Decker has continued to bring top-notch brands to the market, which has led to their market capitalization amassing to $12.17 billion. And while many are looking to Home Depot or Lowe's right now, I'm going to go ahead and go right to the source, given Stanley Black & Decker is a supplier to both of these retailers. And of course, it is severely impacted amidst these market conditions, with a lot of DIY projects put to the side, and of course the housing market, as it is, not looking so hot. Their share price has fallen over 54% on the year, from $191 per share to around $81 per share right now, with their current PE ratio coming in at just 13.6, which in my opinion just creates quite a steal of an opportunity. I'm not alone here, as insiders have been scoring more shares worth of Stanley Black & Decker as well. Following suit is smart money buying millions and millions of dollars worth of shares of Stanley Black & Decker. As of right now, analysts do see upside with an economic recovery, with their share price rising back up to $112.25 per share. Now, as a dividend investor, I am loving their dividend, as it's coming in at 4.01%. And finally, the riskiest of investments of them all, if you will, is the stock that actually may take quite some time to recover. It's VF Corporation, ticker symbol VFC. That's a global apparel and footwear company. Now, since VF's founding in 1899, it has managed to bring 12 popular brands to the market, from Timberland to Vans, The North Face, and Supreme, just to name a handful of them. But as you could guess, with the shift in the consumer spending habits, given high inflation and consumers just pulling back on goods that aren't a necessity for them at this point in time, VF Corporation's top line revenue has been hit, and ultimately this all just spooked investors right out of the position, which is why VF Corporation's stock share price has certainly been free falling from around $73 per share at the beginning of the year to around $31 per share. Now, that's a whopping 55.33% decline, sounding the bells of opportunity, with the PE ratio coming in at just 12.4. Now, I'm honestly in disbelief that VF Corporation, with all of these big brand names, will actually go out of fashion or out of style anytime soon. Therefore, as a dividend investor who's long on my investments, VF Corporation is looking pretty ripe for me. And of course, we also have smart money looking well into the future and investing now in order to make sure that they are able to catch the rebound. Additionally, we have analysts that foresee plenty of upside potential, with a target share price coming in at $41.25 per share. That's nearly 30% worth of upside. Now, honestly, as we just remain patient for an economic recovery, it is quite the dividend that we're going to be able to collect on, with a 6.39% dividend yield. Investors, there you have it, the 7 dividend stocks that I'm currently taking a look at, added to my watch list, and with some of them actually investing into as we speak, given the ability to just park my money with each of these companies and do so for the long haul while collecting on these dividends of theirs. And most importantly is understanding that the long-term value investor will ultimately prevail amidst these market conditions. So now I'd love to know, what have you been personally investing into? Or if you haven't been investing into anything quite yet, what have you been at least looking into in terms of an investment opportunity? Drop all those comments down below. Please note that I'm not a financial advisor, so after my videos, just do all of your due diligence prior to making any investment decisions. Now, before we get going, tap on that thumbs up button. It helps me grow this channel, and most importantly, I'd love to have each and every one of you on this journey with me, so go ahead and subscribe while you're at it. Now, investors, until the next video, I will see you all there.